Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Equity futures down 5 or 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, the bond market sending a message. The rate hikes are over. Secretary Yellen looking for new ways to say the same thing. And TikTok struggling to find friends on Capitol Hill. We begin with the big issue, testing the rally.
The market's been very resilient.
Equities are still fairly resilient.
The sell-offs we've gotten have been, fairly shallow, and people have been pretty happy to re-engage to the long side.
The Fed is up in the zone of being done.
Working on the assumption that one more hike and then we are done.
Folks do want the market to go higher.
Big picture, yields are high, and this market's going to be well supported.
The market is on a hair trigger waiting for the pivot.
I think there's no conviction.
The market has anticipated a lot of rate cuts this year.
People see, different statistics being reported from an economic standpoint.
The labor market is still overheated. Inflation is still very high.
And then they see stories about Credit Suisse, stories about Silicon Valley Bank.
The key question is who is right in that scenario?
We've got a fantastic lineup for you this hour. It begins with JP Morgan's Kelsey Barrow, George Concalves of MUFG. Kelsey, first to you. Was that last hike this week the last hike?
We do think that this may have been the last rate hike in this cycle. And I think the two-year yield is telling you just as much. In fact, it's 100 basis points inverted to the spot Fed funds rate. So the market right now, the Treasury market, is sniffing out this end of cycle. It is sniffing out the potential for rate cuts. But I would say the bright spot in all of this is that Treasuries and high-quality, long-duration fixed income is working as a ballast again in your portfolio for the first time. So we were here at the beginning of the year saying bonds are back. Now I would say bonds are here.
The 10-year down 12 basis points, 330. The 2-year, 362, down 21 basis points. On the session, George, on the session, these moves are just nuts. They've been mental for 2 weeks. If it's the end of the rate hiking cycle, is it the end of the economic cycle?
Look, Jonathan, it might be actually worse than just the end. We could have experienced actually the Fed's equivalent of the Trichet moment this past week. And I think that's a big deal. I mean, collectively, the Fed had the chance. They were even contemplating on pausing, but the market had some priced in, and they delivered on it. And now you have the market actually going the other way. So are they going to start delivering on cuts? Because the market's calling for cuts as soon as the summer. And that's going to be a hard thing to kind of thread the needle on.
George, how can they cut with inflation at 6%?
I mean, look, traditionally, if this becomes a bigger banking crisis, if it truly is going to spread, banking crises are deflationary. They know that. They have experience from the 1930s. The Fed has always been more worried about the 1930s than the ECB, which has been more about the 1970s inflation. So if you really truly have a contraction of credit in the U.S., that will fix the inflation problem.
Kelsey, how much of a disinflationary shock are we seeing play out?
So we do agree with George that this banking stress and this tightening in credit conditions is going to be disinflationary. I mean, don't forget, credit conditions were tightening before the recent banking stress. Now we expect they're only going to tighten further. So, everyone's been talking about the Senior Loan Officer Opinion Survey. That's going to be out. And the way that they do it is they do the survey so that it's available for the Fed 4 times a year around the Fed meeting. So they will have it at the next meeting, and that's what they're going to be looking very, very closely at. They're not going to be looking at what is the backward-looking view, looking at the year-over-year rate of inflation at 5.4%. They're going to be looking at what are those forward-looking indicators saying about growth, inflation, and credit conditions.
So, Kelsey, what does the market feed on? In the meantime, it needs to feed on something. It's not going to be CPI, won't be payrolls. We're ignoring jobless claims south of 200K. Do we just have to sit here and wait for the Senior Loan Officer Opinion Survey?
So in the meantime, I think what the Fed will be looking at is they're going to be looking at credit spreads. If you look at more traditional measures of financial conditions, they look fairly sanguine right now. But then when you look at spreads in the banking sector, particularly the level, but also the shape of the credit curve, it is still indicating a fair bit of stress, particularly with front-end bank spreads being wide. And what you're seeing in the reports from the Fed yesterday, on Thursday, they released the balance sheet data, is that banks still need liquidity. The liquidity crisis may not be getting worse at this point, but there still is quite a lot of demand for the discount window as well as the Fed's new borrowing facility.
With all this in mind, George, how desensitized will this market be to traditional economic indicators?
Look, I think Kelsey's absolutely right. We've been focused on these backward-looking indicators, and it's all about, passing the baton to these forward-looking indicators, especially the weekly updates we get from the Fed's balance sheet. 100% agree with that, as well as, the 2-week lag on the commercial banking data that we'll get also this afternoon. I mean, all of this stuff's going to be super critical. It's usually viewed from like a wonky lens, but considering that's like the most real-time data that we're going to get, that plus the volatility in bank spreads. I mean, all these things are telling you that we should take a pause and wait and see here. And I think the Fed's going to be taking notice of all this very clearly.
George, wait and see is very different to I've made a decision. After 2 weeks of this, the story has completely changed. Which one is it?
I think, look, if this does not stabilize once we get past the quarter, we also have a quarter end next week. If this were to continue into early April, I think the Fed would have to start to really rethink about what they do in May and June.
What is it about this, Kelsey, from your perspective, that you think this story now is firmly in motion? It's something that keeps on moving, rolling in the wrong direction?
Well, I think it's what we were seeing before all of this really started. So we happen to have our investment quarterly on March 8th, so right before all of this really unfolded. And at that time, we had very high conviction that there was a recession in the offing, particularly because the cumulative and lagged impacts of this most aggressive rate hiking cycle since the 1980s was ultimately going to bite. And so I think this really only reinforces the way that we've been positioning in portfolios, which is conservatively in terms of our credit positioning and in long duration in terms of our interest rate sensitivity in portfolios.
And you've been right to be conservative on the credit risk side of things, that's for sure. You and Bob Michael over the last few months. Equity futures right now, if you are just tuning in, welcome to the program. About 23 minutes away from the opening bell. Equity futures down about 0.6% on the S&P. A bit softer on the Nasdaq. No big moves here. We're down 0.4%. The big moves belong to the bond market over the last couple of weeks, that's for sure. In the bond market right now, 2s, 10s, 30s, look, a little something like this. Your 2-year yield down by 23 basis points to 360 on a 2-year, on a 10-year 330. The whole curve back with a 3 handle. At one point in the last couple of weeks, we were talking about the whole curve looking at 5%, particularly at the front end, and that story's totally changed. Now, George, let's revisit the recession conversation. It was depth, duration, diffusion. I want to talk about depth. A couple of months ago, people were lining up to say, this is going to be a shallow one. If we have one, it's going to be a shallow one because there isn't much leverage. Given the introduction of these new risks in the last couple of weeks, do we need to revisit that one?
I think we do. And I think this really puts pressure both on the administration, the Treasury, and really we should really cut the Fed some slack here. They're doing their job in terms of liquidity provider. This really is about getting confidence back into the banking system. But I think, unfortunately, the damage is done. There's been a kind of migration that's been set in motion. And if rates do stay in the cash side anywhere between 4 and 5%, you're going to see cash move towards the money markets. And so this kind of is it's kind of self-inflicted in many ways. But it won't be fixed by the Fed just slashing rates back down to 0. I mean, trying to reliquify the banking system through that approach will open up the whole inflation problem all over again. This is going to require some really creative thinking, not just a blanket FDIC approval. Maybe perhaps thinking about targeting a mini type TARP for the smaller banks. I don't know, but I do think that they have to get more creative. And we've seen this in prior crises. They kind of slow walk the whole thing up until they actually have to do something very bold. It's time to get bold.
You mentioned the money market fund issue. The AUM surging above $5 trillion. This from Michael Hartnett, up more than $300 billion in the past 4 weeks. B of A's Michael Hartnett pointing out that the previous two surges, 08 and 20, coinciding with big Fed cuts. Now, Kelsey, I just want to come back to the rate cutting cycle. I get it. This market's screaming to the Federal Reserve, you're done. The cuts are coming. We don't think you can get to 5.1%. Even if you do, you're not going to be there very long. I understand all of that. Kelsey, when they start to pull back, if indeed they go in that direction, what are they coming back down to? And just please contribute to that conversation George and I were having about the depth of this recession call. Does that need to be revised?
Yeah, so I would say when we think about where the Fed could cut to, we are not expecting that they're cutting back to the zero lower bound. We do think that when they cut, there are reasons why it's not going to be all the way back to zero. But I will say that with this surge in money market funds, I think investors need to be a bit cautious because those instruments are going to have a lot more reinvestment risk once the Fed starts cutting. So you're going to get 5%, but you may only get that 5% rate for 3 months. And if that's the case, you're not actually getting a 5% return because that's an annualized return. You're really only getting 1.25%. And so that's why we're very focused right now on communicating to clients the benefit of locking in those yields at this moment, particularly as those risks, as you mentioned, of the hard landing continue to increase. The severity of that recession could be worse.
Well, Kelsey, this call then is relative to where you think Fed funds gets pulled back down to. So for me to understand how much value is in a 2-year at 360, if you tell me we're not going down to zero, what are we going down to? How much value is in 360 on a 2-year if I'm locking that in for the next couple of years?
So that's a really good question. And there's two things that you need to assess in terms of the valuation of the 2-year. So one, right now we're seeing a huge flight to quality bid, and it's being concentrated in the 2-year. So that's essentially a bit of a risk premium that is somewhat disconnected from what the future path of the Fed funds rate is going to be. Secondarily, even if the Fed only cuts to 1 or 2%, it's the speed in which they cut. And so obviously, if you look at the WIRP page, it's changing every second. But historically, what you've seen over the past few days is the rate cutting cycle that the market is pricing is still fairly, gradual and measured. Generally, when the Fed actually starts cutting, it ends up being quicker than that. And that's what ultimately results in a lower fair value for the 2-year yield.
The way this conversation has changed, the tone of it in 2 weeks is just absolutely stunning. Kelsey Berrow, George Goncalves sticking with us. Equity futures right now down 0.6%, with some movers going into the open. Here's Katie.
Hey, John, let's start with First Republic because shares are back under pressure this morning, even after Secretary Yellen clarified her comments yesterday, saying that regulators are prepared to take additional actions for depositors. But this bank has been downgraded multiple times over the past few days, down more than 45% this week alone. Moving on, Block. It's building on yesterday's sell-off after Hindenburg Research came out with a short report against the payments company. Of course, Block has called those allegations misleading and inaccurate, but you can see shares continue to fall, down about 1.4% pre-market. And finally, I want to get a check on Microsoft after the UK's Competition and Markets Authority said that new evidence showed that Microsoft's acquisition of Activision Blizzard will not result in a substantial lessening of competition. You can see Microsoft down slightly, Activision higher.
Katie, thanks for that. Thank you very much. Coming up on this program, Secretary Yellen looking to reassure markets.
The strong actions we have taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
That conversation up next.
As I've said, we have used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we have taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
Same message, different language. The latest line from Secretary Yellen aiming to avoid a repeat of recent volatility as she closes out 2 weeks on Capitol Hill. The bank's seeing little relief from her reassurance, hitting their lowest level since November 2020. Lenders both big and small now coming back under pressure in pre-market trading. Team coverage begins right now. Down in D.C., alongside Katie Lyons, Bloomberg's Anne-Marie. AMH, first to you. Yellen seemingly finding new ways to say precisely the same thing.
Yeah, it was a bit of a tweak in language, Jonathan, wasn't it? We should quickly just outline exactly what the language has been. So on Wednesday, in her testimony, she wanted to make sure she was reassuring the markets. She said the federal government's recent actions have demonstrated our resolute commitment to take necessary steps. It got a little bit more tricky then in the Q&A. She was asked about Congress and what they should be doing with the FDIC, and she says she's not considered to discuss a, quote, blanket insurance. The market obviously took note of that. We saw bank stocks fall. So then yesterday she came in and said, certainly we would be prepared to take additional actions if warranted. All of this is really about the language and the semantics. We know the Treasury Secretary or those under her were looking at emergency measures they can use, temporarily potentially raising that cap for these depositors. But when it comes to a blanket response or changing it broadly for good, that lies in the hands of Congress. And this is a debate that is taking place right now.
That's the point of tension, and it's a really important distinction you've made, Anne-Marie, throughout the whole of this week. Kayleigh, First Republic down 4.9%. It looks like it's going into the weekend without a new solution.
Yeah, it's been eerie how little news there has been in regard to First Republic. And I keep asking sources down here, is no news good news or is no news bad news? And no one really seems to have an answer because by and large, the thinking is that this bank isn't going to be able to make it without some kind of intervention, given how in the hole they are at the moment. So that is why we see the stock under continued pressure. It is not alone. You are seeing other regionals down in pre-market trading as well, although these losses really do look relatively mild compared to what we have been seeing for these names in recent weeks, because as we well know, First Republic is down about 90% over the last 3 weeks at this point. Its price to book ratio has just fallen off a cliff. The stock is now trading at a sixth of book value. Absolutely brutal. The, of course, concern here is around those deposit outflows. It doesn't seem that the words of Treasury Secretary Yellen are doing enough to quell concern around that, given that would be a reactive action by and large if they see systemic risk being present, not a necessarily proactive one to prevent that deposit flight from happening. So we have to keep this in mind. And of course, for traders looking at how this relates to the economy and ultimately monetary policy, the thinking seems to be we're looking at the banking system, hearing you say you're not going to cut this year and thinking you are wrong because a real tightening in credit conditions is happening. Hence why we're seeing two-year yields falling off a cliff, John.
A break of 12 on First Republic as well. That big move in the bond market. Katie Lyons, Anne-Marie, to the two of you, thank you. So in the bond market, the front end of the curve right now, the 2-year is lower by more than 20 basis points. First Republic, it's a break of 12. It's 11.97. George Concalves, Kelsey Barrow, back with us. Hey, George, earlier this morning, the German central bank governor, the president of the Bundesbank, was talking up, speeding up QT in Q3, talking up more rate hikes. What do you make of the split right now between them and what's happening here?
Look, again, this issue is really primarily still a U.S. issue in terms of the deposit flight and the losses that have been built up in the AFS and held to maturity for a lot of these small and mid-sized banks, where it's a different story for Europe. But I mean, I do think if they were to continue to tighten, it's all about what the yield curve does over there in Europe. I mean, we've had a big move today in global rates. Really, that's what kind of triggered the lower move here in the U.S. as well. So they can, again, they'll suffer the same problem the Fed has suffered, which they can push up the short rate as high as they want. But if the yield curve does not participate in Europe, it's really not going to work out.
Let's talk about the curve here, stateside. Kelsey, your thoughts on this one? 2 Wednesdays ago, feels like a lifetime ago, but 2 Wednesdays ago, we had an ADP report. And I remember the price action after that, the yield curve aggressively, deeper inversion came through, negative 110. And this morning at one point, as high as negative 26. Kelsey, where's that one going?
So we are positioned in terms of our rates trades in an end of cycle trade. So that's long duration and that's yield curve steepeners. So we do think the path for the yield curve here is actually to continue to steepen. So what we see is there tends to be this very quick shift, and it tends to be quick in every cycle, where you go from very aggressive yield curve flattening to a bid in the 2-year yield that drives the yield curve steeper as the market anticipates rate cuts.
Do I want to be sitting in risk assets, George, while that's going on?
No, you don't. Historically, whenever we get the curve to steepen this quickly, and let's be honest, this was a hyper steepening because it happened in a 2-week window. The days before we're at 5% 2-year notes, and 3 days later we're sub 3. I mean, that's just one of the fastest steepening type moves, an unwinding of the flattener, which was a persistent flattener for nearly 14 months, right? We had a big flattener across the curve, then every single part of the curve was flat and inverted. Now that we're trying to get back onto the other side and get into positive slopes, that only happens if the Fed participates and cuts rates, right? So this is a signal that you only cut rates if something's starting to break down even further, not just the banking sector, but the economy as a whole.
So, George, let's build on this. I want to finish on something we touched on a couple of times in this conversation together over the last 20 minutes. This has happened really quickly, in a little more than 2 weeks, and we're unwinding huge positions in the bond market. And I think to some extent, extrapolating out the current experience, extrapolating that out through the rest of this year. George, you mentioned solutions for the banking system. Is there a solution you can think of that takes us back to the world we were living just a couple of weeks ago?
Unfortunately, I don't think there's a silver bullet. I think it has to get either worse or it has to get prolonged enough that it actually encourages some real policy decisions out of D.C. that are not just against the blanket FDIC is a good first step, but I'm not sure if that's enough. I think it really comes down to, what's the role of these smaller banks? How are they going to fit into the financial landscape going forward? And do they need to, at some point, get capital? Because the Fed can give liquidity for a 1-year window. What happens 1 year from now? Their own forecasts are showing weaker growth in 2024. They think this is going to be a very shallow recovery once we come out of it.
Hey, George, wonderful to catch up as always. George Concalves there, and a brilliant Kelsey Barrow on the situation in the bond market, the global economy, and in equities as well. Equity futures right now down 0.75% on the S&P. Going into this opening bow 7 minutes away. Your bond market, bid. Monster rally again. Yields lower by more than 20 basis points. 362 on a 2-year. We're getting used to moves like this, aren't we? Don't get used to moves like this. It is not the typical thing you see in the bond market. It is very, very unusual to see this development consistently over the last couple of weeks, from north of 5 to well south of 4 on a 2-year to about 360. Coming up, the morning calls, and later, banking fears tightening its grip on the sector. We'll get the view from Lafayette's Krishna Mamani and Keith Lerner of Truist. That conversation coming up shortly. Equity softer. Let's get you some morning calls. First up, Atlantic Equities downgrading Block, saying the company failed to deliver a thorough rebuttal to the Hindenburg report. JP Morgan upgrading KB Home, highlighting the company's solid results. And finally, RBC cutting its price target on Goldman, expecting a deep recession to accelerate credit losses. That stock is down to 310 in the pre-market, down by about 1.5%. Up next, global bank stocks resuming their declines. That conversation with Lafayette's Krishna Mamani and Keith Lerner of Truist. Two weeks of banking turmoil, and before today we were poised for a second week of gains on the S&P 500. We're going to take a bite out of that at the opening bell. Equity futures right now down 0.4%. On the S&P, on the Nasdaq, we're negative 0.25%. The drama kind of fades just a little bit going into the cash open. There's the opening bell. Switch at the board and get to the bond market. Plenty of drama there. We're down 11 basis points on a 10-year, 331.31 on a 10-year yield. On a 2-year yield, absolutely plunging. Bramo a little bit early this morning, so the 2-year yield was dropping like a stone. It is. We're down more than 20 basis points to the front end of the curve. Bit of dollar strength out there. Euro weakness. Euro dollar 107.59. We're negative 0.6% for the euro against the dollar. And in the commodity market, down by more than 2 percentage points. 68.40 on WTI. About 25 seconds into the session, equities look softer. by only 0.4%. On the S&P, on the Nasdaq, we're down about 1/3%. Call it negative 0.25%. One stock to watch at the open, First Republic, extended its declines through the morning as investors digest Secretary Yellen's latest comments on Capitol Hill. Kaylee has more. Hey, Kaylee.
Hey, John, yeah, this stock down about 5%. So just adding to the losses it has already seen that have been substantial over the last 3 weeks. We're talking in the ballpark of about 90% over a very short period of time. Really, what we're all wondering is when Janet Yellen says they will take additional action if warranted, is this going to be one of the banks where that action is warranted? Because remember, over the course of the last week, we have had news that 11 larger banks put $30 billion of deposits into First Republic to try to stop the bleeding. It didn't have the desired effect. Then there was the conversation around potentially converting some or all of those deposits into a capital infusion, the government possibly having a hand in that deal. And yet we haven't actually got news on it. For a crisis that has moved very quickly, it seems that anything around this name is moving quite slowly. So we are all still waiting for news as the losses steepen here. And of course, we also got news on this name. The only real news we've gotten is the fact that we've had 4 credit downgrades in the span of a week. The latest came on Wednesday from Fitch, and they specifically cited the altered balance sheet, essentially. The fact that you're seeing withdrawals of deposits and it's being replaced by really costly borrowing, primarily from the Fed's discount window that banks, not just First Republic, but largely have had to tap for liquidity. That is reflected in the numbers. We had that record $153 billion in borrowing from that lender of last resort last week. It did come down in the data we saw yesterday, the week through Wednesday, to just $110 billion. But still, that remains quite elevated relative to history. So it just goes to show you that there is still funding stress out there for these banks. Very unclear at this point how close we are to the end of this particular episode.
Hey, Kaylee, thank you. Let's pause. Look at this move. Let's get First Republic up again. It's a break of 12. First Republic is negative this morning once again, down by close to 5%. Given what we've seen develop over the last couple of weeks, 5% on this stock is like nothing. But look at the fact that it's at 12. Call it 11.90. Go back to March 9th at the opening bell. That stock, triple digits. Triple digits. This mess started really after the close on March 8th. March 9th at the open, triple digits. Here we are at 12. It's been a problem for a couple of weeks. The problem continues. The bank rout deepening across the Atlantic as well. UBS shares dropping after Bloomberg reports that the DOJ is investigating whether it's among the banks that helped Russian oligarchs evade sanctions. Jan Patrick Barnett joins us now. Jan, let's talk about this. This is why they wanted the government guarantee. You never want to inherit someone else's legal problems. How big might they be?
Yeah, that's absolutely true. And we know that Credit Suisse has a reputation for not doing business always by the book. So that could become a problem for UBS down the road. The two lenders have now to pull off a mega merger with lots of uncertainty in there. And the last thing that you want to have is some uncertainty, especially on the legal side, that is interfering with your efforts to align those two big operations, and certainly making investor nervous about more bombshells lying down in the cellar.
You and I have been talking about Deutsche Bank, another name, throughout the whole of this morning. Let's go back and forth on it again. DB's down about 10% or so. I'm trying to work out, Jan, what's driving the move this morning. Is this just general risk aversion across the whole continent, or is there a reason why Deutsche Bank's getting hit specifically so hard?
Well, I would say like there's a little bit of both in there, right? So it's not that Deutsche Bank is like the main problem child here. We see a bigger risk-off move in European assets and stock markets, and banks are getting hit across the board. Last week it was Societe Generale and BNP being the underperformer. This week it is Deutsche Bank. Of course, we know that Deutsche Bank had problems with like capital and their business model back in the day. So it's always like kind of a first choice for investors when they want to reduce risks. But I would say like this move that we are seeing is much bigger and much broader in terms of people positioning for a recession, and in this term for banks also positioning for earnings contraction rather than like a massive hit to capital or any liquidity issues or any instability in the banking sector as a whole.
That's where the underperformance is this morning over in Europe on Deutsche Bank. Jan Patrick, thank you, sir, as always. Deutsche Bank negative, close to 10%. UBS negative as well. UBS also on the receiving end of a downgrade this morning. Jefferies cutting shares to hold and writing the following. UBS was forced by events into this Credit Suisse deal. Negatively, it changes the equity story of UBS, which was based on a lower risk profile, organic growth focus and higher capital returns. All of these elements, which is what shareholders bought into, are gone and likely for years. That sounds like a sell, not a hold, but it's a hold. from Jefferies on UBS. With us now, Lafayette's Krishna Mamani, Keith Lerner of Truist. Krishna, you've been great over on Twitter. I've been following your tweets on the banking situation, and there was a line you used, Krishna. The crisis isn't about deposits, it's about cheap deposits. Krishna, what did you mean by that?
Well, so if you look at the situation, if you are looking for replacement for your liquidity, you have BTFP and you have a discount window and you have federal home loan banks to kind of provide you that liquidity. The problem is that that liquidity comes at market rates as opposed to coming at 0% or 1% kind of a rate. And if you are having a problem in your books because of profitability, that is getting exaggerated. So what we are quickly transitioning from a liquidity crisis to now a profitability and capital crisis. That's at the end of the day, if left unchecked in 6 months' time, that's what we'll be talking about.
Well, the key caveat there, if left unchecked. Krishna, what can they do about it? Do rate cuts, are you suggesting rate cuts can address this?
Well, rate cuts could certainly address this to some extent. However, I don't see that forthcoming anytime soon. I think Jay Powell made that amply clear. I think vulnerable banks will have to come around to raising some capital relatively quickly and not wait till the day of the crisis like SVB did. So I think at the end of the day, if you want to save your bank, raising some capital at this point, even if it is at a huge cost in terms of dilution, that's something that you have to contemplate. That really, at the end of the day, is the solution.
Keith, two issues. One, some of these names face an existential crisis. We get that. But two, the broader sector, given recent developments, is going to face real profit headwinds. How investable do you think this sector is right now, from your perspective?
Well, I think it's going to be challenged. I think, as far as the one thing that's been discussed, probably ad nauseum, was that lending trends were becoming tighter even before this happened. Lending trends are only going to become tighter. There's going to be more regulatory scrutiny. And I will say, I think part of the challenge with this market is, like, yesterday you made a 2-year low in the U.S. bank index, and now you're also seeing that this morning overseas. So, you think about credit's the lifeline of the economy. We think recession risk is relatively high later this year. And even if the Fed cuts rates, we don't think that's going to change the trajectory. And all you have to do is look back at 2007 or 2000, knowing those were different situations than today, to see just because you cut rates, that is not a panacea for either the economy or for the overall market. And therefore, from an overall strategy standpoint, Jonathan, we still remain defensive.
So, Keith, it's never just about the data. On this show, we always say it's not just about the data, it's about how the market responds to that incoming information. Keith, last time you and I spoke, we talked about what you called the reverse Tepper trade, where basically bad news was bad news and good news was bad news. What is it now? I'm trying to understand how this market is going to respond to incoming information in the weeks ahead, given the introduction of these new risks over the previous 2 weeks.
Yeah, I think, on the reverse Tepper trade, I think the bad news is that more likely the economy is going to slow down. And along with those tighter credit conditions, profit trends are also going to weaken as well. What's curious to me as I look at the earnings growth or the estimates for the second half, analysts are looking for the S&P earnings to make all-time earnings high as far as on a quarterly basis in the second half. And that's just not consistent with an economic slowdown that we see. So the other thing I'll say, Jonathan, too, is if you look at right now, all the things we're talking about, I think it's hard to argue that we don't have above average macro risk, right? Equity markets and credit markets are trading around average. So why are the markets trading around average when we have above average risk? Our view is they shouldn't be. And therefore, again, I think there's some downside risk both to credit and also equities more broadly.
Krishna, do you agree?
Well, I think there are substantial risks to both credit and equity for sure, given the way things are trending. But I would caution here that drawing too many conclusions from the bond market reaction for equity market, at least at this point, may seem a bit premature. I think what Powell did was basically told the bond market that the risks for now are really one-sided, which is rates go down because of a tightening crisis, or the credit conditions tightening. So I think bond market takes that clue and runs with it, and that's what they're supposed to do. Whether that will be validated by data, I think, is an open question today. And I think that's why, and that's what the equity market is thinking about. So it may come about that things slow down catastrophically, but it may also come about that things don't slow down as much as the bond market is fearing today.
Well, Krishna, you just said something interesting. You said whether that will be validated by data. And the first thing I thought of is, what data? Are we going to pay any attention to incoming economic data points for the next month, the next 2 months, as we wait to see what the consequences were of the previous 2 weeks and what's about to come from the banking system?
I think we are probably going to discount near-term data, especially sort of pre-March data, as lagging data for sure. And that's what we are supposed to do. Having said that, I think if the growth trend or employment and hourly earnings and other things kind of continue to reinforce the point that economy is not slowing down the way the 2-year notes would have you believe, I think that cannot be ignored for too long. We can ignore it for a couple months, but I think if it persists, that will not be ignored.
This is what Jim Bullard's got to say. First Fed Speak of the Week, post-Chair Powell hits the tape. Bullard says this: inflation remains too high. The St. Louis Fed president goes on to say it's appropriate for monetary policy, that it can keep lowering inflation. Macroprudential policy can contain financial stress. Keith, what are you looking for in the Fed Speak in the coming weeks, and how relevant is it, given that this market is just living in its own world and trading on the future and discounting what it thinks is going to develop, which is ultimately an economic downturn off the back of financial stress, which delivers a disinflationary shock and tighter financial conditions?
You know, I think, Jonathan, I mean, before you even say what we're looking at, even if the economy doesn't slow down as quickly as maybe some folks are concerned about, you're already, in our view, trading at optimistic levels given the outlook. I mean, you're trading at above a 17 multiple for the S&P. If you look at high yield spreads, they're around 500. During a recession, the average is about double that. So to us, I think we're not really pricing in that much bad news more broadly. And then you look at the the S&P and look at the sectors. Technology is leadership right now, but it's trading at the highest premium in about 20 years. And then you look below that, defensive areas aren't acting great, and we're seeing cyclicals come down again. So, as far as what we'd be looking at, I think the initial jobless claims will be important to validate that the economy is going to slow down. But our point of view is all this what we're talking about today. To us, not a lot of that is actually priced into the market today. It's to us still somewhat complacent relative to the news. If the market was marked down because sentiment is really negative, we would be much more positive here. We're just, we're not seeing it in the valuation data.
Krishna, something Jeff Rosenberg of BlackRock said earlier this week, I think you'll appreciate. The risk cuts both ways. We're all sort of focusing right now on the issues that have developed over the last 2 weeks, that it's going to develop tighter lending standards, financial conditions, disinflationary shock, all of that stuff, all the bad stuff. What we're not focusing on anymore is this idea that the Fed may have to stay here, stay where rates are, because inflation is going to be sticky through the rest of this year. Krishna, how much of the latter view do you think we need to pay attention to?
Yeah, so I think Rosenberg is a smart guy. So I think his point is a very valid one. That is, what we are reacting to is really a banking crisis, and the banking crisis may actually have a significant impact on credit conditions and growth outlook today. But saying today that what has happened in the banking sector may lead for the Fed to be cutting rates in June or May, I think it's a bit of a stretch at this point. And market is leaning one way hard, probably because of positioning, especially in the bond market. And I would guess that at some point that rectifies itself in not too distant a future.
We'll see. Hey, Krishna, this was great as always. Alongside Keith Lerner, Krishna Mamani there. 14 minutes into the session, your equity market shaping up as follows on the S&P 500, down about 0.7%. Coming up, TikTok in the hot seat.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it.
How would you describe it? That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Ford Motor CEO Jim Farley. That conversation at 12 p.m. Eastern, 4 p.m. in London. This is Bloomberg.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it. I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
But you know what? I find that actually preposterous.
What a grilling on Capitol Hill. He never had a chance. The TikTok CEO facing off there with lawmakers in Washington. His testimony failing to satisfy officials eager to ban the video sharing service. Team coverage begins right now with AMH in Washington alongside Mandeep Singh here in New York. Anne-Marie, first to you. That's not how I would describe it. Those words, brutal.
It was brutal for him. The criticism just would not stop. He didn't get a moment to breathe. This was more than 4 hours of questioning and all these lawmakers critiquing his company. But Jonathan, there's really not much we learned from yesterday, except for the fact that bipartisanship, when it comes to this vitriol and concern about the TikTok app, that is alive and well in Washington. What really was key yesterday was what happened before CEO Shou Chu arrived at the Capitol. And that was the statement from China's Commerce Ministry saying that they would have to approve any sale for TikTok. And this just really undermined his entire testimony because lawmakers were trying to draw that link throughout this 4.5-hour hearing that TikTok does have some sort of link with the Chinese Communist Party.
Mandeep, if you're Meta, if you're Snap, you must have enjoyed that yesterday.
I think so. And look, when it comes to video content, even though Meta has, 2 billion daily active users, TikTok is where most of the video content, user-generated video content comes from. And that's why, the platform is so powerful is because, it has that engagement. So if you're a Meta or a Snapchat, you want to bring more creators on the platform. And this is the type of thing that can, shift the creators towards a new platform. Now, we did a survey where we found YouTube is still the preferred platform as an alternative to TikTok because YouTube has a revenue sharing model where they share the revenue with creators. Meta and Snap don't do that. So we still think YouTube will be the biggest beneficiary if there was a ban on TikTok.
Those year-to-date moves for some of those names, wild, just monster moves. I want to come back to you, AMH, just quickly. Just got a headline that Secretary Yellen is convening top regulators. What do you make of that? How important is that issue?
Well, she's meeting with them this morning after we go into this third week, right, Jonathan, of this concerns and contagion in the banking sector. Obviously, there's concerns still about U.S. regional banks, First Republic being top and front and center. But then also there's concern about what's going on with Europe, with Deutsche Bank also deeply under the weather today. So she's meeting with these top regulators, not sure exactly what is on the agenda. But we look forward to see potentially any readout this afternoon from the Treasury Secretary.
It's not how I would describe it. I'm still trying to work out how he would describe it. Anne-Marie, Mandeep, forgive me. I'm going back to the TikTok story again. Breaking news just about 5 minutes ago. Let's get you some data. Here's Mike McKee.
All right, John, the S&P Global PMIs are out for the United States. They are all better. Manufacturing at 49.3, up from 47.3. Global services, 53.8 from 50.6 and 53.3 for the composite. That's up from 50.1. Basically the same story we saw in Europe, where all of the manufacturing indexes remain below the 50 level, but all of the service industries are above 50. Also, we have some headlines out from Jim Bullard basically saying Fed did the right thing. They had to separate the financial crisis from the inflation crisis. He says financial stress can be harrowing, but tends to reduce the level of interest rates, which could help the banks overall.
Mike, this week is never ending, isn't it? I imagine we'll get more Fed speak over the next week.
It's not.
It's got to end at some point. I feel like it started like March 8th, and it's just kept going. Mike McKee, thank you. We've got about 22 minutes into this session. Gone about 22 minutes into the session, and equities are down 0.7%. Katie has some sector price action. Hey, Katie.
Hey, John. Well, really quickly, let's look at those sectors. You can see utilities, consumer staples managing to stay in the green this morning. What's more interesting maybe is the losers. You have energy. That's been under pressure all week. Financials also under pressure, down almost 2%. If you look back over the past week, though, we know that yields have just absolutely plunged. An interesting response, though. You have tech higher, as you might expect, but utilities, real estate under pressure, not exactly the response you would expect.
Katie, thank you. Up next on this program, the Trading Diary, just to get you to the weekend and perhaps get you there quicker. We're 25 minutes into the session. We're down about 0.5% on the S&P. We're down 0.2 on the Nasdaq. That's the price action. Let's get to the Trading Diary. How do you stay out of trouble? You schedule a meeting with a Canadian leader. It's always safe that way. President Biden meeting with his Canadian counterpart at 11:30 Eastern Time. Fed speak picks up on Monday. Fed Governor Jefferson, plus we'll hear from Barkin, Collins, Williams, Waller, Cook throughout the week and a whole lot more. You get 2 days of congressional hearings on Silicon Valley Bank kicking off on Tuesday. Fourth quarter GDP, another round of jobless claims on Thursday. And we close out the week with the Fed Vice Chair for Supervision, Michael Barr's testimony on Capitol Hill. Look out for that. If you can, enjoy the weekend from New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.